Hello, everyone, and welcome. I'm so super excited to welcome this very special guest, my dear friend and trusted CPA, Kellyanne Roers. Um, as everyone knows, I'm always looking and researching for what's and thinking about what's ahead so that we can better prepare our startup dentists, practice owners that are just jumping into their first practices. And when I read her recent breakdown of the one big beautiful bill, I knew that I needed to just bring her voice directly to you to answer all these questions and for my own personal knowledge and understanding. She's an expert, and I have so much respect for her. And I know that this new legislation has big implications for dentists. And so, whether you are an associate, a practice owner, or planning your first startup, while I am not a tax professional myself, I just always feel like I want to help you ask better questions, plan smarter, and avoid surprises. So Kellyanne is going to walk us through what's changing, what it all means, and what action steps you can take right now to set yourself up for success in 2026 and beyond. So without further ado, thank you so much, Kellyanne, for being so generous with your time and answering my call and joining us today.
Thank you so much for having me again. It's a pleasure to be here.
Thank you. So let's jump right to it, right? Like, let's start big with what is the most important takeaway from this new tax legislation for the average dentist?
So, whether you are an associate or a practice owner, I think one of the biggest takeaways is the SALT cap increase, especially for people who are in a high income tax state like California or New York. And previously, with the Tax Cuts and Jobs Act, as of 2017, they took away your right to deduct your state income taxes, and they put a cap on it at $10,000. So between your real estate taxes and your state income taxes, you can deduct it, but it can't be more than $10,000. Now, they changed it for 2025, and effective, this tax year, you can deduct up to $40,000.
That is a significant change.
Yeah, especially like the two of us who live, on Long Island. We pay state income tax. We pay high real estate taxes. Your real estate taxes alone hit that $10,000 cap. So, it's a huge difference. And I think, for most W-2 earners, this is probably going to be the biggest change on your tax return. However, there is a little caveat. It does phase out.
Okay.
So if you are making over $500,000 a year, it does start to be reduced. So, just keep that in mind. But for all the, under $500,000 earners, this is going to be a big win for you.
This is great news because I think that the perception and I think when we get into the politics and some of the things behind it, who's doing what, there's always that preconceived almost prejudice, right? Like, oh, it must be bad or and so I'm so happy that that you're helping answer these questions for us, because at the end of the day, there's always an opportunity when there are new changes that are taking place, but we just have to do our due diligence and understand where is there the opportunity for me. And so, again, I'm here as a student myself. I am going to be taking advantage of these things, and I may have a assumption that it must be something bad because there's so much negative information flying around and going things. So, and we'll go over some of the pros and cons and how to protect ourselves and whatnot. But this is huge. I think that being able to take advantage of this change is absolutely something that this is why I brought you on, because I had all these questions and you're helping me and so many people get the answer. So another question that that I have for you is if you can help us break down a few of the key changes that practice owners or future startup dentists should really pay attention to.
So, one of the biggest benefits for new startups, I think, is going to be the change for the bonus depreciation.
Okay.
So, people talk about depreciation and it's kind of a difficult concept. Like, when you buy assets such as equipment, chairs, furniture, all of these things, or let's say leasehold improvements, right? Because a lot of startups are doing a build out like before
Yes.
they're, opening up. All of these things have what's called like a life, and they have to be depreciated over a certain number of years. And some things it's 5 years, some things it's 7 years, some things it's 15 years for improvements, let's say. So if you spend $100,000 on leasehold improvements, technically without any special depreciation, you have to divide that over a 15-year period and you get the deduction incrementally year over year. Now, that's not great for startups, right? Like we want to get we want to accelerate this depreciation and take it sooner rather than later. And there's two ways to do that. So there's either bonus depreciation or Section 179 depreciation. And
write that down.
Section 179 is great because it does allow you to deduct 100% if it's eligible in year one. Awesome. However, it has restrictions. So there's a cap on 179, which was like over $1 million. You can't deduct over $1 million. A lot of people that doesn't apply to, so that's great. You were able to do 179. However, if you have a loss, which a lot of startups do have a loss in year 1, 2, whatever the case is, Section 179 is like use it or lose it. So if you have a loss, then you don't get to carry that forward to future years. So that's where bonus depreciation, separate from 179, totally different, allows you to take that loss and carry it forward. And we had bonus depreciation with the Tax Cuts and Jobs Act. However, it was phasing down and it was 100% for like 3 years. And then it became 80% and then 60% of the asset and then 40%. And then it was set to expire completely.
I see.
So now we get to 100%. Yeah, exactly. So now it's changing and we are able to do that 100% of those assets again, which is huge. It's huge for anybody who's buying equipment. It's huge for anybody doing improvements or buying buildings. If you are a more seasoned practice owner and you're buying a building
from the beginning, I do have a mix of doctors that buy into the real estate. So this will be applicable if you're a startup, but you're purchasing the actual real estate, correct?
Huge for them. Yeah, absolutely.
That's awesome. I'm so glad that you're helping us with these questions. I also want to, because I have my own questions, and then there's so much to unpack that I want to take advantage of some of the questions that we did a survey, and some of some people have been asking these questions. We had our team look into that, and we want to be able to as many questions as possible to answer. But just know that if you're watching this episode, we're going to have Kellyanne's information so that you can schedule a consultation with her. I know that there is, and I wanted to highlight and reshare, because this is one of the things on the description of this episode. We're going to have a link to your article, because I read it and I learned a lot from it, but having you go over it, and this is how I came up with my questions before the survey, it's going to have such an impact. And we're on the last quarter of 2025. And so this is the time for you to start planning ahead, because failing to plan is planning to fail. And, I always say that success is where planning and opportunity meet, right? So we are being presented, it seems, with certain opportunities, right? And we have to be proactive and plan ahead. So my call of action to everyone watching, because this is totally alien to me, I want you to go ahead and schedule a consultation with Kellyanne to go over your specific needs. But the third question that I have for you, and I think this is one that it's going to be, because you see everywhere doctors looking to do continuing education, and what can I do in terms of my deductions internally through my operations, right? So can you help us break down, like, what are some of the deductions that dentists might be gaining or losing under this bill, and what can be done about it?
So, if you are one of these earners that are making over $500,000, like, kudos to you. That's where we all want to be, right? That's, why you spend $500,000 going to dental school. But if you are, you might be in the pool of people who are losers in terms of these changes. If you are under that threshold, you were saying before, there's some negative connotation around like these changes and what's happening with the government, but it's like, no, you have to remove yourself from the media and actually dive into what's a part of this bill and see that, like, there really are no losers under $500,000, and this really is beneficial for most taxpayers. Are there additional deductions for business owners? Yes, in terms of the bonus depreciation, that's great. In terms of, if people keep asking questions on, like, what about tips? What about overtime? And, like, that doesn't really affect the business owner. Okay. Right? As an owner, you're not getting overtime. You're not getting tips in the dental field. So, will it affect your staff? Yeah, maybe. So, like, in terms of the overtime rule, I know people are like really concerned about that. Like, oh, I get to deduct any overtime. And you know what? We do have staff in the dental field that are working overtime hours. So, if they meet the criteria of the specific level of employees that are eligible for overtime, then they, as staff members, may be able to deduct their overtime up to $12,500 per single and up to $25,000 for married filing jointly. But that's if their income is under a certain level. Has to be under $150,000. So, that may be a great benefit for your staff. You don't have to do anything, though. This is like, through your payroll service on their personal returns, doesn't really affect you.
Now, I think maybe this is something that I misread in some of the groups, speaking about, like, losing some of the benefits of CE or licensing or uniform deductions disappearing. Is this so?
So no, that's not true. Basically, with the Tax Cuts and Jobs Act, it took away unreimbursed business expenses. And that was for people who were W-2 employees and had to pay out of pocket for their continuing ed, their uniforms, etc. So pre-2017, you were able to deduct it, but it also still had thresholds. So it wasn't like you were able to deduct everything. It was a little bit of a red flag, a little bit of a gray area. Like, some states do still allow you to deduct those things, but it has to be in excess of a certain amount of your income. And then you have to itemize on top of that. So it's, really what you have to get to now is negotiate. If you are working as an associate, negotiate with your employer and see if they can reimburse you for these extra expenses that you're going to incur.
That makes a lot of sense. Perfect. So for those of you who are associates and you're listening in, there's also opportunities for you to have a CPA that is looking into your relationship with your employer and the way that you're filing certain things as a W-2 employee as well. And so this is something that I think everyone can benefit from learning more and creating a strategic, personalized plan for them. One of the things that we always have to discuss, because dentists are either concerned about their, they go to dental school. You mentioned the cost of going into dental school and already the debt that implies just getting your degree. And then a lot of them want to start practice ownership, whether it's acquiring an established practice or launching an office from scratch. And dentists are really struggling and juggling between the loans that are like the startup loans or the student loans. How should they think about overall like tax planning in this situation as it refers to um, this bill and some of the advantages and disadvantages that they can expect and take advantage of?
So, to put it flat outright, there's really no deductions for student loan interest if you are over a certain amount of income, and that amount is very low. That amount, is around $75,000 for a single, person. So we are making over $75,000 when we're coming out of dental school, God willing. So, that right off the bat just means, hey, I can't even deduct my student loan interest. There's no, perhaps you can have, a company reimburse you for some of your student loan payments, but there's a maximum on that. It's really not going to make a dent in your hundreds of thousands of dollars of debt. What you really need to focus on is, what are the interest rates?
Okay.
What is my cash flow?
Okay.
And how can I pay this off? And,
Okay.
I don't want to ignore my debt. Like, I don't think you should be paying the minimums. I think you need to work in coordination with multiple advisors who are going to be able to help you with this, to come up with a game plan. Because it could feel like a huge burden. Like, how am I going to go buy a practice? How am I going to go buy a house if I have all of this debt? Well, you can still do it, but we just have to come up with a plan, and you have to realize that we're going to work this plan, and it may be over a long period of time, and you got to get comfy with that.
Got it. You touched on a point that is very interesting. I just had a doctor reach out to me and say, and I definitely referred him to you. I said, I think this is a question. I'm gonna introduce you to someone, and it was something about, hey, I need a car, right? Like, can I buy the car through the business? And I think this is one of the questions that were surveyed about. Like, the question was, how can I write off my car loan interests? Mm-hmm. So tying into what you just answered about like creating a plan for, their debt and their student loans, and working with the team of advisors like yourself, what answer can I give to this doctor, since I already had the question and I have the opportunity to ask you real time?
So now they did include in the bill that you can potentially deduct up to $10,000 of interest on a new car loan.
Okay.
So that was something that needed to be obtained in 2025 until 2028. So this is over the next couple of years that we can take advantage of this, but it has to be a U.S. assembled passenger vehicle. And the vehicle has to be the security on the loan. So, it could be a great opportunity for people who are W-2 employees to write off a piece of their car where they couldn't do that before. $10,000 of debt of interest on a car loan is super high. That really means you have to be, buying a really expensive car. So, we don't want high interest rates on car loans, but if you do finance a vehicle, then there may be some tax benefit to it as opposed to leasing. And you have to kind of weigh the pros and cons. Like, what does the lease payment look like? What does the finance payment look like? How much is the extra interest per year? And what is it actually saving me? Because it really only saves you a percentage of your based on your tax rate. So if you're in like a 25% tax rate, you're only saving 25% of the $1,000 a year that you're paying for interest. So you get a $250 deduction. Is that really going to make or break anything? Like, You have to, there's a lot of little things in this bill that may have an effect, but like at the end of the day, is there anything that's like, I'm saving tens of thousands of dollars a year? No, there's not.
Yes, and I think that that's an important point, because a lot of times we don't know like the fine print or the details. And what you're saying is, yes, it sounds great to someone that is completely like accounting illiterate to a certain degree, when they say, oh, you can have up to a $10,000 tax write-off when you buy a vehicle. But the implication is you're saying on the tax of the financing, right?
Yeah, on the interest portion of the finance. So
yes.
it's like when you pay something that's $500 a month, you might only be paying $50 of interest a month or $100 of interest. So it's like when you start doing the math, it's like, okay, maybe I'll save a couple $100 here.
Yes. So it's not worth it, because it's going to put you in a position where you have to really spend a lot of money on the vehicle, or at least it needs to be an expensive like the interest rate has to be so high to justify the you being to qualify for this. That's my understanding, right?
Yeah.
So some things are just not worth looking into, because obviously it doesn't apply to all of us. But so you've answered most of the questions that came through the questionnaire. Now, one of the things that I wanted to wrap up with, or to ask you, is just to pick your brain on like one tax mistake that you see dentists make all the time.
Good question. I mean, I've been seeing so many mistakes lately, and it's been like this for a while. First, you really need to educate yourself and read through the returns. I know that it's difficult and it becomes foreign, but like just overview, does this make sense? Because I've had someone recently who was reporting their income on their personal tax return. They had a practice. They were doing their books themselves.
Oh.
And they submitted, their books, but it wasn't properly put on the tax return, and it looked like a big red flag. So, there were missing deposits, there were missing expenses. So the profit was not correct, and it had a big effect. And then penalties and interest continue to accrue if you don't pay the right tax. So that's like number one. And I'd say number two, I think a lot of people talk about like becoming an S corporation. Oh, that's like the best way, to eliminate tax. But I always say that it's really not the best way until you're making at least over $150,000 of profit. And then it may be different in some places like New York City. If you're in New York City, forget about it. Like, got to be much higher than that. But people do an S corporation and then they don't take payroll. And that is like the number one requirement for an S corp.
Yes.
You must take payroll. So people come in the door and I'm like, we can't continue to do this. You're not in compliance. This is a red flag.
And so my question to you is, for the people that have been giving the wrong advice, and they are currently, they set themselves as an S corp, right? And they were making a $50,000 or $100,000 profit, right? Can they reverse that and go back and into just filing as an LLC instead of a S corp?
That's a great question. And of course, we love this answer in the legal world and the accounting world, right? I'm not an attorney, but it depends.
Okay.
So, if it was the first year that you did it, you could technically withdraw your S election.
Okay.
Within the first 3 years, there are criteria that you could revoke it as well. But technically, when you do become an S corporation, you are not supposed to unravel it for 5 years. So you're really committed to it for 5 years. So you better make sure that you're going to anticipate that kind of income over the next 5 years. And otherwise, sometimes we shut it down and we just start a new LLC. I mean, especially if you're just like becoming you're just an associate, you're getting paid as a 1099 contractor, whatever the case is, like you could just start another LLC. Yeah, of course, for most states, you probably have to go through the Board of Education and get approved because you need a professional, LLC or whatever the case is. But I think sometimes it's worth it in order to have the right tax set up.
That is, I mean, this is huge. And so the takeaway for this last question is, because I always say I'm not a financial advisor, and I always rely on a team of experts that I can refer my clients to. And even when I have questions myself, I lean on to the experts. And this is information that even within the accounting world, I must say, you get mixed information, right? So you have to be also very careful of who you choose to work with, and who you listen to, and they have to back the answers that they're giving you. Because personally, I will tell you, I've heard a lot of mixed information about when is the right time for you to do, and these are expert webinars that one will attend, from a expert speaker that is invited to, to some things. And every situation is different, I assume, for everyone. But for our audience, the dentists that are listening, and correct me if I'm wrong, because I'm just rephrasing what you're saying just so that it holds a bigger impact, just rephrasing it to make sure that the message is received and that I understand it accurately. Unless you're making $150,000 in net profit, it's usually best for you to refrain from filing as an S corp. Did I get
Yep.
that right?
That's correct.
Okay. And so, yeah, so this is going to be definitely something important for us to do. I can't think, but again, I think, Kellyanne, this has been incredible. I really am so grateful, and always an honor, because every time I connect with you, I'm always learning. I know that you are a, powerhouse. You have a small family, you have a amazing growing business, and you really take the time to always stay up to par with all of the changes with in the accounting world. And so that, to me, the fact that you're taking the time to answer these questions for myself and for my audience means the world to me, right? So thank you for helping us take these complex, changes feel a little more approachable and relevant to all of us, right? Especially for us trying to build something while juggling a million things like our young dentists are, and they're also growing a small family. Which brings me to one last question, and this may be selfish, but I wanted to know, like, there is this thing like the Trump Kids account or something like that. Can you break that down for us? Like, what are some of the implications about you wanting to add your kids to payroll? When is the right time to do that? Or is it something that I'm crazy to think about or consider?
So, there's a lot of unknowns around these Trump accounts right now. They haven't released a lot of the final regulations, and I'm sure that they probably will by the end of, maybe around December, maybe January. We'll see. That's to be determined. But basically, these Trump accounts are going to act like IRAs.
Okay.
And they will be set up like through the Treasury, for individuals that are going to be eligible, which, that don't have an account already. So, this is something that we're still waiting on more information for. But in terms of like when to hire your kids, or, to put them on payroll and then have a retirement strategy for them, I think that that's a great tool to be able to, when your kids are able to do tasks around your office and help you out, it's a no-brainer to shift income over to a lower tax bracket where you can shift over, practically $15,000 over to your child at a 0% tax bracket, and then they become eligible to contribute to a retirement plan. And it's a huge tax savings if it fits your family.
Got it. And that is if we are making a significant profit, I suppose, right?
Correct. Yes.
Beautiful. I mean, thank you so much. For all of us, or any of our audience that is listening and feeling a little overwhelmed, I don't worry, because I guess the goal is not to become an expert overnight. I am a student. All of us are students. it's to really get informed, right? To ask better questions, to work with professionals like Kellyanne, who can help us create smarter financial plans for your practices and for your future, right? So, as a gift, I know that I'm going to be including on this episode the link to Kelly Ann's original article that shows like the notes, along with some a few tools that she's created to support in mapping out like a 4 year planning, right? And so, again, if you're thinking about launching or growing your first practice, you can reach out to me. And if you have an established practice or if you're an associate, no matter where you are in your journey in dentistry, you definitely need to connect with a team of advisors that you can trust, you can rely on, and that you know are going to have your best interest at heart. And I will tell you from my personal experience, the experience of my clients, I've known Kellyanne for so many years, and it's always a pleasure to have her not only as a friend, but as a resource that has been able to support so many clients in her journey as a dental specific CPA. And I encourage all of you to go ahead and take advantage of the opportunity and her knowledge and work with her, no matter where you are in your journey. Kellyanne, I wanted to ask you one last question before we wrap up, and it is, what are some of the the questions that dentists should be asking their CPA before the end of 2025 to prepare for this?
So I'd say, a lot of people are only meeting with their accountants once a year to give them everything, prepare a return, and there's a lot of unknowns, right? But this time of year, especially, we're meeting with our clients and running a full-blown tax projection, which is basically like a mock tax return to show them, based on all of your year-to-date information, your pay stubs, your estimates, your income. We need to make sure that you know what your tax bill is going to be approximately, right? We have 6 months to file your personal income tax returns. I don't know about you, but I don't like big surprises. So, if I owe $40,000, I want to know, and I want to be able to plan for it accordingly. Because if you give the information to your accountant on March 1st and you owe all that money by April 15th and you have no idea, then that's how we get into a little bit of a pickle. So I think just planning early is important. And, as a courtesy, whoever has any specific questions, if you're watching the video, I'm happy to just shoot me an email, reach out on Facebook, whatever the case is, I'm happy to answer if I can.
What is the best way to connect with you?
So email is really the best. It's kelly@kroerscpa.com. You can Google me. You can find all that information there. LinkedIn. I'm all over the place. So just a simple Google search and you'll be able to find me.
And for all of you, we're definitely going to have her information on the description. I'm wishing everyone a very productive, profitable end of 2025. And as Kellyanne said, we cannot stress it enough. Failing to plan is planning to fail, and success is where opportunity and planning meet. Plan accordingly so that you can have a very successful 2026 and beyond. Kellyanne, thank you so much again for your time today. God bless you and your family and your business, and looking forward to staying in touch with you.
Thank you so much.
Awesome. So let me stop the recording.
Perfect.